Hi, welcome to the Florida Homestead Accelerator. In this module, we're going over the standard $50,000 homestead exemption. What it is, who's it for, how it works, filing conditions, along with reminders. For example, deadlines, requirements, status changes, and at the end, a case study. Basically, the Florida homestead is a property tax exemption created by the government to reward and protect people. We're going to start with the two primary parts, property and people. Qualified properties would be continual land up to a half an acre within the city or continual land up to 160 acres outside the city with a residential home permanently affixed to the land. For example, a building or a mobile home. So what's this qualified people stuff all about? We basically got to prove to our local property appraiser we're a Floridian. It's as easy as being a U.S. citizen and providing the following documentation: a Florida driver's license, a Florida voter registration, maybe your car is registered in Florida, and so on. Let's say you're a green card holder and you have the following documentation: a Florida declaration of domicile, and you have a Florida deed, etc. So we know about qualified properties and qualified people. Now let's see who qualifies. It all depends on occupancy. Let's say you purchase a home on a lot that's less than half an acre within the city limit, and you're a qualified Florida resident. Now, are you actually going to live in that home? If the answer is yes, then you're good to go. In short, we talked about three things. You need to own a qualified Florida property and be able to prove you're a Floridian who lives in that qualified property as your primary residence. Now here's the fun part. How does the standard exemption reduce your property taxes? Without going into all the details, your local property appraiser uses a complicated formula based on millage rates and your assessed value within different tax categories. To simplify, I'm going to give you a couple examples. Say this year your home was assessed at $250,000, and this would be the value used to calculate your taxes, but after you apply the standard exemption, your assessed value goes down and you pay less taxes. So when you do the math, it's going to look something like this. 250,000 minus 50,000 equals 200,000. That's your new assessed value that your property appraiser will use to calculate the taxes you have to pay. There's more to it though. The standard $50,000 exemption won't apply to all your taxes across the board. Here on the left are your different tax categories. You'll notice the public schools are broken down into state and local levels. The way the exemption is written, you're not going to get the full exemption there. It's going to look something like this. As you can see in column 3, this is how your assessed value is used to calculate your taxes. One last thing to keep in mind, the full $50,000 exemption seen here is for homes $75,000 and more. For homes less than that, it'll be prorated. Here are some practical use cases to give you an idea how versatile the homestead is. Most common would be someone that owns a condo, or maybe a married couple that owns a single family home together, or maybe a couple but just one person is on the title or mortgage. Least common would be someone that's a co-op apartment owner, or different people living together with joint ownership of a house, or maybe somebody that's a beneficiary of a trust with ownership interest and the right to occupy. Just keep in mind this exemption is not for a business, rental property, second home, or any property owned by an LLC. Also, you can't have multiple homestead filings. Here are some friendly reminders for you. You want to file before the 1st of March deadline, and when you do go to file, know that the 1st of January is when occupancy is determined. Meaning, the year you go to file, you must have been living in the home as of the 1st of the year. Last thing, make sure you notify your property appraiser if your homestead status changes. For example, if you sell the property or maybe you move and start renting out the property, it's really important you keep your homestead in good standing, because if you forget, you could end up dealing with a lien, paying penalties, and interest that goes back as far as 10 years. In my case, I purchased in 2013 and I moved in before the end of that year. The following year, in 2014, I was living in the house as of the 1st of January, and I filed for homestead before that 1st of March deadline. I kept track of my property taxes for the first 7 years, and I know if I didn't have my homestead exemption, I would have paid a total of $42,000 in property taxes. But instead, thankfully, I paid $36,000, which resulted in a savings of $6,000. Here's what it looks like in a graph. There you go, Module 2 complete. I'll see you in the next one.